$311. In one day, gold just posted its largest single-day dollar gain since 2008, the year the financial system collapsed. $2 trillion shifted in a single trading session. That is roughly the entire market cap of Amazon moving in 24 hours. No earnings report triggered this, no CEO announcement, no emergency Fed meeting. The oldest form of money on earth just sent a message. And if you are not paying attention, you are about to miss the most important market signal in over 15 years. Let me start by giving you context, because without understanding what just happened, you cannot possibly position yourself for what comes next. Gold moved $311 in one session, up 6%, $286 per ounce. That is the biggest one-day gain since the 2008 financial crisis. Silver? Up 14%, from the low 70s just days ago to 85 now. Copper rallying right alongside them. When gold, silver, and copper all surge together on the same day, it is not retail traders speculating. It is not hedge funds making momentum bets. It is not technical analysis playing out. It is the system itself repricing what money fundamentally is. Jesse Livermore, one of the greatest traders in history, called moments like this the market telling you something. He said smart money listens before asking why. They react first, analyze later. But here's what almost nobody is connecting right now. While gold and silver are making these historic moves on screens, the physical market is telling an entirely different story. One that should concern you deeply or excite you tremendously, depending on which side of this you are positioned. Physical silver is near impossible to source right now. Not expensive, not premium heavy, impossible to find. Major bullion dealers just posted public statements saying the physical market is under serious stress. Silver especially near impossible to source. Mints closed, refineries backlogged for weeks. Most competitors completely sold out, so we have two realities running parallel. Paper prices making massive moves, physical metal vanishing from the market, and that divergence is about to reveal everything you need to know about where precious metals go from here. Now let me walk you through what led to this moment, because the technical setup predicted this volatility with surprising precision. A few days ago, I identified a specific zone, $87 to $90 for silver. At the time, we were trading around 80. I explained that if we moved higher, that zone represented key resistance, a confluence of technical factors that would either confirm a trend reversal or reject the move and push us back down. Yesterday, we hit that zone, price touched 87 to 90, and we got rejected. Bulls tried to push through, they failed, price got shoved back down to 85 where we sit now. That rejection is significant. It tells you there is real overhead resistance. It tells you the move is not clean yet. It tells you caution is still warranted despite the bullish headlines. Now here's the critical technical detail everyone needs to understand. There's a moving average I've been tracking closely for weeks, the 150 exponential moving average on the hourly chart. This is a dynamic level that helps identify support and resistance in real time as price evolves. When we were trading above $100, I said if we close below this moving average, we could see the early 90s as support. We did close below it, and we did see early 90s briefly before crashing all the way to 71. Then I followed up with another analysis discussing the new Federal Reserve Chair appointment and how that macro shift could push silver even lower, potentially below $86. That scenario also played out exactly as outlined. Now here is where it gets critical for the next move. That same 150 exponential moving average that acted as support when we were above it is now acting as resistance, and it currently sits at $96. We are at 85. $11 below that key dynamic level. The 87 to 90 zone I called, we touched it and got rejected. That matters because it confirms bulls tried to reclaim that moving average zone and could not hold it. When support flips to resistance, that is a bearish technical signal. It means momentum has not fully reversed yet. It means the structure is still damaged. But before you assume this is purely bearish, let me show you the other side of the coin. COMEX open interest just hit multi-month lows. For silver, 142,000 contracts. That is the lowest level since May. For gold, 414,000 contracts. Lowest since June. Open interest measures how many active futures contracts are held in the market. When it craters like this, it signals capitulation. Weak hands flushed out, leveraged long positions liquidated. The forced selling phase is complete. Historically, when open interest drops to multi-month lows, bottoms form. Not always immediately. Sometimes it takes days or weeks. But the washout is done. The panic sellers are gone, so we have competing signals. Technical resistance overhead at 96 telling us momentum has not confirmed, but open interest washed out telling us the forced liquidation is complete. This is the setup, and understanding it is critical for navigating what comes next. Now let me take you into the physical market, because this is where the real story is unfolding. And it is a story mainstream financial media is completely ignoring. One of the largest and most respected precious metals dealers in the world just posted a public update. Here's what they said. Physical market under serious stress. Silver, especially near impossible to source. Mints closed. Refineries backlogged. Most competitors empty. They went on to explain that they have inventory because they planned ahead. But even they had to make adjustments. They reduced their buy and sell minimums from 20,000 Singapore dollars down to 10,000 just to maintain customer access during this period. They are adjusting premiums in real time to reflect actual physical market conditions, not paper spot prices. Physical reality, this is not speculation, this is not hype, this is documented reality from one of the most credible sources in the industry. Now think about what that actually means. You cannot fake closed mints. You cannot fake backlogged refineries operating at capacity with weeks of delays. You cannot fake competitors running completely out of inventory. This is physical scarcity. Real supply constraint happening in the tangible world while paper prices on screens show $85. Let me give you the current numbers so you understand the disconnect. Western spot and futures markets, $85. Shanghai spot market, $100. Shanghai futures, $101. Shanghai premium over Western paper, $15, 18% premium. After a crash that took silver from 120 down to 71, a 40% drop, that premium should have collapsed. If the fundamentals were actually weak, if demand had genuinely broken, that premium would be zero or even negative. It is not. It is compressed from the highs, yes, but it is still elevated, still showing that physical demand in the world's largest silver market has not cracked. Now let me explain why this matters beyond just numbers on a screen. When you see a disconnect between paper price and physical premium, it reveals which market is real and which market is derivative fiction. The paper market can be manipulated with futures contracts. Algorithms can dump thousands of contracts in milliseconds. Stop losses can be triggered. Liquidation cascades can be engineered. But the physical market, you cannot manipulate closed mints. You cannot algorithmically create silver bars that do not exist. You cannot trigger stop losses on metal sitting in a vault. Physical is real. Paper is claims on physical that may or may not be honored. And right now, physical is screaming one message. There is not enough metal at these prices. Dealers cannot source it. Mints cannot produce it fast enough. Refineries are backed up for weeks trying to meet demand. While paper says 85, reality says try buying volume at that price and see what happens. You will get one of two responses. We are sold out, or we have inventory, but the real price is not 85. It is 100 plus with premiums, two markets, two prices. One is a screen, one is reality. Now, let me show you another piece of this puzzle that mainstream analysts are completely missing. Central banks are still buying gold, relentlessly, aggressively, regardless of price. 328 tons of gold purchased by central banks in 2025. That is just slightly below the 345 tons they bought in 2024. Poland led the buying with 102 tons. Kazakhstan added 57 tons. Turkey, India, China, all accumulating. But here's the number that should make you stop and think. Central bank gold acquisitions have continued for 33 consecutive months, 33 straight months of net buying. The 12-month moving average stands at 27 tons per month. That is massive sustained demand at the sovereign nation level. These are not momentum traders. These are not retail investors chasing gains. These are central banks, the institutions that manage national reserves and monetary policy, choosing to allocate into gold month after month, regardless of whether price is up or down. Why does this matter? Because central banks have access to information and analysis that retail investors will never see. They have economists, strategists, geopolitical analysts, all advising them on how to protect national wealth. And for 33 straight months, their conclusion has been the same: accumulate gold. They are not doing this because they think gold will go up 10% next quarter. They are doing this because they see structural risks to the global monetary system that make gold the only viable hedge for sovereign reserves. Currency debasement, debt spirals, geopolitical fragmentation, de-dollarization. All of these macro forces are pushing nations toward hard assets. And while they accumulate, the paper market tries to shake out retail holders with volatility and price crashes. Do you see the game? Sovereign buyers accumulating at every level, physical market under stress, mints and refineries unable to keep up with demand, and paper price showing $85. One of these signals is telling you the truth. The other is designed to separate you from the asset before the next major move higher. Now I want to give you historical perspective, because without it, the current volatility feels insane and unbearable. With it, it feels normal and even predictable. Let me take you back to Germany, 1914 to 1923, hyperinflation. During that period, gold price went up 1 billion times. 1 billion. From the start of the currency collapse to the end, gold multiplied by 1 billion in local currency terms. You would think that means holders got rich easily, right? Just buy gold, sit back, wait for 1 billion times return. But here's what actually happened. Monthly volatility during that period ranged from negative 30% to positive 160%. In a single month, gold could drop 30%. Then the next month, rally 160%. Then crash again, then rally again. Even with perfect foresight, even knowing gold would eventually rise 1 billion times, holders experienced gut-wrenching volatility that shook most of them out before the final move. This is what precious metals do during currency crises. They do not go up in a straight line. They go up in violent, chaotic, unpredictable surges separated by brutal corrections that feel like the end of the world. Right now, we are living through a similar pattern on a different scale. Silver crashed from 120 to 71. 40% drop in days, then bounced 20% back to 85. Now testing resistance and potentially setting up for another move. This is not a broken market. This is what metals do when the underlying currency system is under stress. And make no mistake, the system is under stress. Global bond yields are spiking. German 30-year bond yield just hit highest level since 2011. U.S. 10-year Treasury approaching highest since August 2025. Japanese 10-year near highest since 1999. When bond yields spike globally like this, it signals systemic stress in the foundation of the financial system. Debt becoming harder to service. Confidence in paper promises eroding. The initial reaction is always risk off. Sell everything. Raise cash. Wait for clarity. Only after the initial panic does safe haven buying into gold and silver fully activate. So if you are wondering why metals are not straight up despite physical scarcity, this is why. The process has phases. Panic liquidation first, strategic accumulation second. We are transitioning between those phases right now. Let me lay out the bullish case in detail. Not hype, not hopium. Just the objective data points that support higher prices from here. Point 1. Physical silver near impossible to source. This is not speculation. This is documented by the largest dealers in the industry. Mints closed, refineries backlogged, dealers lowering order minimums just to maintain access for customers. You cannot fake this. This is real supply constraint in the tangible world. Point 2. Central bank buying 33 consecutive months. Sovereign nations are not momentum traders. They are strategic allocators protecting national reserves, and for nearly 3 years straight, they have chosen gold every single month. Point 3. COMEX open interest at multi-month lows, silver at lowest since May, gold at lowest since June. This signals the forced selling is complete. Weak hands out, leveraged longs liquidated. When this metric craters, bottoms typically form shortly after. Point 4. David Hunter, a credible analyst with a strong long-term track record, just raised his gold target from $5,500 to $6,800. Raised silver target from $125 to $180. While everyone else is panicking, experienced analysts are raising targets based on fundamentals. Point 5. Chinese yuan just hit strongest level against US dollar since May 2023. Yuan strengthening while dollar weakens supports structurally higher gold and silver prices in dollar terms. Pricing power is shifting east. Point 6. Shanghai premium still elevated at 18%. After a 40% crash, if fundamentals were truly broken, that premium would be zero or negative. It is not. Physical in China still trading well above Western paper. Point 7. Gold just posted its largest one-day gain since 2008. The financial crisis. That does not happen in dying bull markets. That happens when something fundamental is shifting in the monetary system. Point 8. The narrative that the new Fed chair will save the dollar and crush metals is mathematically impossible given debt levels. The United States cannot run a Paul Volcker-style tight money policy with debt to GDP over 120%. Interest payments would consume all tax revenue. They will have to pivot back to easing eventually. And when they do, that compressed spring we are seeing now will release with enormous force. This is the bullish case, not hope. Data. Now let me give you the bearish case, because ignoring risk is how traders and investors get destroyed. Point 1. The 150-hour exponential moving average at $96 is now resistance. We tested 87 to 90 and got rejected. Could not hold, got pushed back to 85. When support becomes resistance, that is a bearish flip in market structure. It means momentum has not confirmed a trend reversal yet. Point 2. Bitcoin dropped below 74,000 for first time since April 2025. This is significant because Bitcoin often leads risk sentiment across all alternative assets, including metals. When Bitcoin breaks down, risk off spreads. Point 3. S&P 500 down 0.8%, NASDAQ down 1.5%, Wall Street Fear and Greed Index back at 39, fear territory. Broad market weakness often drags everything lower initially before divergence occurs. Point 4. Global bond yields spiking aggressively. This creates forced selling across all asset classes as institutions need to raise cash to meet margin requirements and rebalance portfolios. Point 5. Geopolitical risk escalating. Reports of potential U.S. military conflict with Iran. While this should eventually be bullish for safe haven assets, the initial reaction to war is often risk off. Sell first, ask questions later. Point 6. If silver cannot reclaim $90 and hold above the 96 resistance level, technical damage suggests potential retest of 71 lows. Point 7. Nothing is confirmed yet. The bounce could be a dead cat bounce, a temporary relief rally within a larger downtrend. We need to see follow through above key resistance levels before calling a bottom. This is the bearish case, real risks that cannot be ignored. So what is smart money actually doing while retail traders panic and mainstream media declares precious metals dead? They are accumulating physical, quietly, aggressively, at every price dip. Central banks buying relentlessly for 33 straight months proves sovereign entities see value here regardless of short-term volatility. Experienced precious metals analysts like David Hunter are raising long-term price targets while everyone else capitulates. Large physical dealers who planned ahead still have inventory and are adjusting premiums to reflect real market conditions, not paper spot fiction. Meanwhile, retail is panicking, selling paper contracts at a loss, exiting positions after a 40% drawdown, getting shaken out by the exact volatility that always accompanies major bull markets in hard assets. This is the wealth transfer, from emotional hands to strategic hands, from those who react to screens to those who understand fundamentals. Smart money is not looking at hourly charts. They are looking at debt to GDP ratios, currency debasement rates, central bank balance sheet expansion, physical supply and demand dynamics, and all of those metrics point in one direction. Higher prices for hard assets over the long term regardless of short-term volatility. So what should you actually be watching in the days and weeks ahead? $96, that is the critical resistance level, the 150-hour exponential moving average. We are $11 below it right now. If silver can reclaim $90 and then break and hold above 96, that is bullish confirmation. It means the structure has repaired, momentum has shifted, bottom is likely in. If we fail to reclaim 90 and start testing 80 or below, more downside is probable. Could see a retest of 71 lows before finding a final bottom. The 87 to 90 rejection matters. Bulls tried and failed to hold that zone. That is a warning that resistance is real and the move is not clean yet. But physical scarcity matters more, central bank buying matters more, open interest washout matters more, technical levels tell you timing, fundamentals tell you direction. Gold just moved $311 in one day, the largest gain since the 2008 financial crisis. The system is repricing what money is in real time, right in front of you. Physical scarcity is real, central bank accumulation is real, technical resistance is also real. If you are a long-term holder focused on decades, this volatility is noise. Ignore it. Stack when you can. Focus on fundamentals. If you are a trader using leverage, every level matters. Know your risk. Have a plan. Execute with discipline. The war between paper and physical is entering its final phase, and your outcome depends entirely on which reality you choose to believe. The screen, or the vault, the derivative, or the metal? Choose wisely, because this decision will define your financial position for the next decade. The $2 trillion signal has been sent. The question is whether you are listening.